Greetings, comrades. I'm going to rip through these 10 tips fairly quickly. So I'm just pointing out that if you want a bit more depth in terms of how to work through some of these practical questions, you can check out the playlists on my channel, particularly the exam tips. But I'm trying to constrain the view time of this video to make it user-friendly leading into the exam. Tip 1. When you are required to reconstruct a ledger in order to calculate a mystery figure, there are marks on the table not just for arriving at the correct figure, but also correct cross-referencing, dating and totaling up. So this question from the 2024 exam, what we're required to do is reconstruct a capital ledger to work out the cash contribution. So what a few students missed out on was this entry right here. We've made a net profit of 6,000. So that's going to increase your capital, and so therefore that's a credit to your capital. There's no such ledger as net profit. So therefore we need to think what ledger would be impacted by that, the profit and loss summary, if we subtract our expenses from our revenue. So again, when you are cross-referencing, even if it's a ledger reco, you must cross-reference that with another ledger title. There's no such title as net profit. Tip 2, when you arrive at a total, subtotal in your income statement or cash flow statement, you've got to have some text and context next to it. So in this question here, we're preparing the financing activities of the cash flow statement, and we've got some information here to work with in terms of working out our financing activities. And there's 4. This is a 5-mark question. The 5th mark is on offer for stating what this total represents, is 41,000. We must actually identify this as net cash flow from financing activities, same as if it was operating or investing. Also in your income statement, if we're calculating gross profit, we identify it. Same with adjusted GP and same with your net profit. So don't just total up a number. We need to give that number context in the cash flow and the income statement. Tip 3. When we are reporting the carrying value of a depreciable asset in our balance sheet, we need 3 figures. So first of all, we've got to identify our verifiable purchase price, the cost, and then we less our ACDEP. So in this case, we subtract our carrying value here from our purchase price to get our ACDEP. And then what a lot of students miss, or some students, is they miss reporting the faithfully represented carrying value. So again, for any NCAs, you need 3 figures, cost minus the ACDEP, you underline it, and then over here we identify our carrying value to basically support the faithful representation QC. Same process if we're reporting accounts receivable and we have an allowance for doubtful debts. So we've got a balance here, we've got an allowance here. So again, in our balance sheet extract here, we've got the accounts receivable less our allowance, and this is what is often missing for students. We need to reflect our faithfully represented value of our accounts receivable given past history has determined that we need to estimate a certain percentage of those debts that are doubtful and will become bad debts. Tip 4. When we have a disposal of an NCA, we need to be careful with the impact of that on the purchase of a new NCA. Most students are pretty good at working through the 4 steps of a disposal. We transfer the historical cost to the temporary account, and then we transfer the ACDEP that's been allocated thus far, and then we record our proceeds, and then we work out our profit or loss on disposal. Students are good at this, but we need to be careful that we don't double up on costs when we're buying a new one. So if we look at this question here, we've traded in the old one for 15K. So there's no money changing hands. So for that entry, rather than debiting the bank, we debit the actual value of the computer. So if we had a computer ledger here, we would have 15K cross-referenced with our disposal because of the trade-in. Then it tells us that we've got a new one that had a cost of 105. So that means the total value of our computer is 105K because that's what it refers to in our cost. And then it says the balance was paid in cash. So that 90K gap between our trade-in value and the cost, that's our cash at bank. So my point with this tip is students will often put the full 105 down here in terms of the value, and that would mean we'd be doubling it up with the 15 trade allowance. Another trap with this one is the GST. So the GST is basically paid on the full value of the computer. The trade-in won't affect it. It won't reduce the GST. So that GST is literally 10% of the cost of the asset. And so then you need to basically add those two amounts together to arrive at our reduction in our bank balance. So again, looks pretty simple, but when you're under the pump time-wise, that's kind of an easy one to miss. Whilst we're working with disposals, just be really mindful about your detail in your cross-referencing of either a ledger or a general journal. So therefore, we've got to specify, just like we do with depreciation adjustments, which NCA is being impacted. So in this question here, our ACDEP on our van, that needs to be referred to in our cross-reference as ACDEP of van. If we just have ACDEP on its own, that's not going to cut it. We've got to identify, even in the disposal account, what that ACDEP relates to. And same with the loss on disposal. So we work out our cost minus our ACDEP and our proceeds. We've made a $2,800 loss here. But again, we've got to give this context. So therefore, we need to refer to this as the loss on disposal of the van. Again, whether it's in a GJ entry or in a disposal ledger, make sure any type of disposal or depreciation reference refers to the actual NCA. Tip 5. Often when we have transactions where there's a GST impact, it hits students' blind spots. They just miss some of the subtle details. So if we look at this question here, it's asking you to identify the items that would be reported in the cash flow statement. It doesn't specify operating, investing or financing, so they're all up for grabs. If we look at the mark structure, that's kind of a bit of a hint in terms of how many we need. So students are pretty strong at going, all right, well, we've got the sold here for 13,000, so therefore that's going to be a investing outflow, and we've bought a new one in terms of there's a check there, so therefore that's going to be an investing outflow down here. But what students missed a lot was there's a GST impact on both of these, and they need to be reported separately. So those that disposal and purchase of the NCA, that yes, they're investing inflows, outflows, but the GST attached to those cash transactions will have a twofold effect in terms of your cash flow. They're operating inflows, outflows. Tip 6, be careful with your GST cross-referencing. Again, I've already mentioned cross-references need to identify the other ledger affected by the transaction. So in this question here, what we've got to do is work out the value of a GST settlement. So it tells us down the bottom here, we've got a GST settlement that was paid to the ATO on the 30th of June. It doesn't tell us the amount. We've got to work backwards to work that out. Tells us down the bottom here, just under, GST payments for the period were 20,900. There's no such ledger as GST payments. Those funds are going to come out of the bank. So therefore, that's cross-referenced with the bank. Then in terms of our balance, we got that over here. So it's telling us to put it on the credit side. That one's a nice and easy one. And if we work backwards, we don't need to worry about the GST and all these expenses. We've already been told the GST payments. So therefore we need to look, well, have we got any GST inflows? So yes, we have. We've got some sales here. All sales are made on cash. So therefore, if we multiply our cash sales by 0.1, we're going to get 32.5K worth of GST receipts. There's no such ledger as GST receipts. So therefore, we credit our ledger with a cross-reference to bank. Now, in terms of the actual settlement, we total up our credits, we put a match in terms of our debits, and we work backwards to work out the value of our GST settlement. Now, again, there's no such ledger as GST settlement. So therefore, these funds, again, will come out of the bank. We don't combine it with the GST payments. We keep it separate. It's a separate type of transaction. So therefore, we've got two debit entries to the bank. One is for our standard GST payments on our expenses and any GST that we might have paid on NCA purchases, and the other entry is for our GST settlement. I've done 2 videos during the year on allowance for doubtful debt. Students really struggle with this, so again, you can check one of the playlists, Unit 3, to backtrack if you need help with this. But again, just a final tip. So what we're going to do here is a couple of GJ entries for the additional info points. We've got a 2,750 amount here that's deemed irrecoverable, so that's going to be a credit entry to the ACREC account, and then we've got to separate the GST from that by dividing by 11 in terms of a debit to your GST. We're never going to get that GST, so when we sold to Ramsey, that would have been a credit, so now we reverse that with a debit, and we do a debit to our allowance account. So then in terms of the next part, bad debts, we basically need a ledger. So, and it's a 4-step process. The first step is put in your balance from the previous year. That'll either be a percentage of net sales or they'll give it to you like they've got here. So that's on the credit side. It's in the credit side of our TB, 3,000. Then that's step 1. Then step 2 is we record on the debit side, like we've done here, any write-offs. So therefore, we just cross-reference that. If we were doing a ledger with the ACREP account for that 2,500, again, make sure you exclude the GST. Then we put in our estimate for the next period. That's going to be step 3, balance. Not good on my stylus here. We've got 4% of our net sales. Our net sales are 100, credit sales 90,500 minus 500, that's 90K. We multiply that by the estimate percentage, 0.04, and that's 3,600. Fill it up, 6,100. Match that on your credit side, and therefore the bad debts adjustment is going to be that 6,1 minus 3,000, 3,100. So therefore, and again, you might be going, well, that's not the same as our balance. There's a $500 discrepancy between these two. And that's because there's a $500 discrepancy between these two. We allowed for 3,000. We only had 2.5. So therefore, we're squaring up. So part B, which is getting pretty ugly in this question, show how the accounts receivable would be reported in the balance sheet. We've got our balance at 110. We subtract the 2,750 that we just wrote off, which is how we got to that 107,350. And then that balance, that 4% of the 90K, that goes here. And like I talked about before, we've got to identify our net accounts receivable to satisfy the faithful Rep QC. Be mindful of the impact of accruals on the 3 reports. In this question here, at the end of October, we've got $1,000 owing, that's accrued. Then we're told a few days later, we're making a payment. It doesn't explicitly say it, but always presume, unless told otherwise, that a payment will include any accruals that relate to that expense item. Same for interest. So therefore, that 2,600 is coming out of the bank. That's the figure that's going to go in our cash flow. So if you're asked to do a cash flow, we put in the full 2,600. We can just report it as a wages payment operating outflow 2,600. The actual 1,000 accrued, well, if we had an accrued wages ledger we would have done an adjustment, a debit to wages in October and a credit to the liability. So that needs to be extinguished. So we need a debit entry there to signify that that liability is dead. And then the rest is the wages expense incurred this period. So importantly, just be mindful. If you're doing an income statement, you're going to report in the November income expenses that you've got a $1,600 expense for wages. That goes in the income statement. Cash flow, we've got a $2,600 outflow, and that accrued wages is dead. If we had some more accrued wages, then again, we'd put whatever that figure was in our balance sheet at the end. Tip 9, when we've got prepaid expenses, you need to basically look, did we have any balance at the start? So if we look here, $5,800. There's no, in this pre-adjusted trial balance, there's no insurance expense. So we need to work out how much is being consumed. We go downstairs and we find that we've paid an insurance policy for $3,600. Now I know that doesn't match up with the $5,800. So what's happened here is we made a payment in September and we had some prepaid insurances rolled over from the previous reporting period. So what we've got to do is got to work out how much is being consumed, and we're going to work with this figure here, and importantly the dates. It doesn't matter when we paid it, it's when the policy commences. It commences on the 1st of September, it says that here. We're doing our balance at the end of December. It's an annual policy paid for the year, so therefore we take our $3,600, we divide it by 12, that's $300 per month. And there's a few ways we could handle this, but ideally we want to work out how much is going to be left. How much is going to be left when we get to New Year's Eve, 31st of December? Well, we've used up September, October, November, December. We're going to have 8 months left. So if we go $300 per month times the 8 months that will still be prepaid when we get to New Year's Eve, because those 8 months will run from 1st of Jan to the end of August. That means we'll have $2,400 left. So if we take this prepaid insurance amount in our balance and we subtract the $2,400 that will roll over to the previous period, then we end up with $3,400 of insurance that has been consumed, which is where we get this figure here. If you have to calculate depreciation for a income statement to work out an expense, you might have to do multiple calculations. So if we look at this one here, we need to work out how much depreciation are we going to cop for the equipment. So therefore, it tells us right here, we're working on a 25% per annum using the RB method. So if we go upstairs here, equipment less our ACDEP, that'll give us a $96,000 carrying value. We multiply that by the RB rate and we get 24,000, a quarter of 96. We're doing our reports on a monthly basis. So therefore we're going to divide that by 12 and that's 2,000. But we backtrack other payments in June. We've got some equipment, which includes GST. So we need to subtract that. So therefore, if we divide by 11 and subtract that, we get equipment of 4,800. We multiply that by the RB rate as well, because that applies to all equipment, and we get 12,000 per annum. And we divide that by 12, and we get 100. So therefore, if we add that 100 for the new equipment, plus the 2,000 for the old equipment, we end up with 2,100 expense for our depreciation.